Hi, welcome to your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff publishes his notes on Sunday, and we'll dive right into some of the salient charts and thoughts. The full note is available to subscribers on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to your Finance TV to stay on top of our content. Jeff, welcome back.
Great to be here, Mehdi, as usual.
So as we're filming this, futures are a little bit weaker. It's pre-market. They're down about 40 basis points. The bearish narrative seems to have kicked in a little bit around some of the weaker earnings we've had overnight. There's been some positives as well, though. The debt ceiling concerns seem to be rising and a continued gloomy commercial real estate picture. But before we get into the nitty-gritty of your note, as always, let's kick off with your top-down thoughts.
Sure. Last week was a tough week for the S&P. The first 4 days of the week saw a pretty sharp decline, yet Apple reported what was considered by most to be an upside surprise, right? And, they beat the lowered consensus estimate, yet nobody's talking about the simple fact that revenues were down almost 3% for the second quarter in a row. This is no longer a growth story, right? And we're paying 28 and a half times for Apple. I don't see the point. But it's a big company. It's got a great balance sheet. It's got the backing of Warren Buffett, and it's slowly but surely becoming a bank. So for all practical purposes, that may work to its favor in the short run. The way I kind of look at the market right now is two things. Number one, we've got the most bearish setup imaginable in the S&P 500, except for one possible small problem. That was Friday's upside gap left what's known to market technicians as an island reversal in place. And unless that gap is filled, it increases the probability that we're going to push to a new recovery high that exceeds the February 2nd high. As long as we hold below that February 2nd high, the bearish count that we've been following closely, remains intact. If we do push above that February high, that would take us to our alternate count, which suggests that there's some additional upside. We expect to about 4,300, give or take. And then we should expect to see things move to the downside. So, what we've been kind of dealing with here is a scenario of significant downside potential for the S&P 500, but it's been pushed out. It's been delayed, potentially by fundamentals, somewhat better earnings, albeit, since the first of the year, estimates have come down by over 7% broadly for the S&P. And so when we hear about companies beating the estimate, these are companies that are beating dramatically lowered estimates. And so I don't really view that as being a positive, especially when the year-over-year earnings reports are coming in negative. That being said, we continue to be skeptical about the market. We have seen, some quantitative models that we have turned positive. And honestly, let me just make this point. That has resulted in a significant uptick in net long exposure by CTAs. These are quantitative, systematic traders that are largely influenced by price and volatility movements. And as we see price move higher, most of these CTAs had been, out of the market. They'd missed the entire rally off the October lows, and now they're buying in at the highs. And that's because we're seeing these systematic volatility signals and, moving average crossovers that are bullish signals. And what I noted is that, net long, if you look at the COT data for last week, net long exposure is at the highest level it's been since pre-COVID. Over 2 million net long contracts, and over 1 million of those are CTAs. Everybody talks about how hedge funds are net short. The biggest net short position that leveraged hedge funds have had. It's actually only 25% of open interest. That's not big at all. In fact, that's not even as big as it was when they had their smallest exposure year to date. So when I think about things in relation to the overall big picture, the longs far outweigh the shorts at this point. and that's the risk point to the downside. If we do see some price action to the downside, that's a major liquidation overhang that the market has to contend with. So for that reason and many others, we're continuing to suggest that our clients remain patient, okay? Minimize net equity exposure. We think there's plenty of great shorts out there to offset your longs. You've got to be invested, and maximize your cash reserves at this point. We think 3-month T-bills at 5.25% is a gift. It's one of the best. It's the fattest pitch in the market right now. Put it that way.
You know, patience and cash. That's what we're focusing on, and just stay firm, stand firm. So banks have been a focal point over the last couple of weeks, obviously, and as your title suggests, bear market and banks ain't over yet. You're definitely seeing some potential downside on this space.
There was a great article in the New York Times the other day, written by Professor Amit Saru of Stanford Business. He's actually a fellow at the Hoover Institution, and he basically published a white paper that shows that 2,300 of 4,800 U.S. banks are currently technically insolvent because the losses on the securities in their held to maturity portfolios exceed their net equity. And so they are technically insolvent, not from an accounting perspective, but if they had to liquidate those security portfolios, it would wipe them out. And so, that doesn't even consider the risk of commercial real estate refis over the course of the next year, where about 25% of the loans of all banks are in major commercial real estate. About 15% of these loans are in office property and retail. And, quite a few of those, a large percentage, I think something on order of around 20% come due this year, and all of them come due within the next 3 years. These are buildings that are going to have to be refinanced at maybe double or triple the rate that they were financed at, 5 to 10 years ago. And so this poses a significant risk. If we look at the BKX on the left and the KRX, this is the KBW Bank Index and the KBW Regional Bank Index, both of which have basically plummeted through key support levels. We see significant downside. I think the BKX, the KBW Bank Index, could fall to 50 minimum. I mean, that's a starting point for where the bottom comes in. With the Regional Bank Index, I think 70 is a good starting point for where the lows will come in. But there's significant further bearish potential here. So I would not get excited about banks. Take the advice of Warren Buffett, who over this weekend, his silence was deafening. The fact that he's not buying banks that are down 50, 60%, 80% in the case of some of these small regional banks that have been having some problem. PacWest comes to mind. The silence is deafening, right? So I would not be looking at banks here. I would be looking to short into any sort of a bounce here.
Interesting. This is a great chart that we're looking at here. It's both the S&P and NASDAQ kind of have been at similar levels as 2 years ago. But when you look at them with an equal weight lens, it's starting to tell a bit of a different picture. Talk us through this.
Yeah, I'm hearing a lot of bulls talking about how, the S&P 500 is exactly where it was 2 years ago. And if we take a look at margin debt, it's lower today than it was then. And if we take a look at, this, that, and the other thing, I'm like, well, take a look at the number of stocks trading above their 200-day moving average today versus then. That's a lot lower, okay? Take a look at the equal weight S&P 500. And, while the S&P is 15% below its all-time high, take a look at the equal weight index. It's actually 8% below its February high, okay? Where, a lot of these, cap-weighted indexes like the NASDAQ and the S&P are kind of, challenging that February high. In the case of the NASDAQ, it's actually made a new high on a recovery basis. And if we look at the equal weights, the equal weight NASDAQ is 5% below that February high. And both the S&P and the NASDAQ are 10, 15% above their October lows. That's not very much, a 10% decline, and we're back to the October lows on the average stock, right? So I think that if we're looking at the S&P today versus 2 years ago, the picture is bleak, believe me. And if we think about conditions, economic conditions, where 2 years ago the government and the Federal Reserve was throwing money at the market and at the economy, today they're withdrawing it. Okay, well, we just completed an $800 billion fiscal stimulus package. That's over. We're not going to see that again next year. They can't even balance the budget. We got a debt ceiling crisis right now. How are they going to issue another $800 billion in free money to throw at the market? It's not going to happen. Second thing is the Fed's withdrawing $95 billion a month from their balance sheet. They're letting the balance sheet run off, despite the fact that they've had to swap out collateral for banks. That's not going back into the economy. There's a credit crunch. Banks are not lending. They're withdrawing from the lending circuit at this point. And so, you got 5.25% short-term rates on the Fed funds rate right now. 2 years ago, it was zero. All right. Even if the Fed has stopped raising rates, they're not going to cut. And even if they cut, they're not going to cut by 525 basis points. So we're way tighter today than we were 2 years ago. And that is going to restrict economic growth, and it's going to restrict the stock market.
So away from financials and the banking sector, the tech sector has also been quite a focal point as well. And it's certainly been in somewhat of an outperformance mode. Is it overstretched at this point, would you say?
That's putting it lightly, wouldn't you say? As we were talking offline, 7 stocks account for 103% of the performance of the S&P 500 through the end of April. The other 495 stocks in their aggregate from a cap weighted perspective, actually had a negative impact on the S&P 500's performance. So, those 7 stocks, of course, are the big mega cap tech stocks. And, when we take a look at this index, which is technology, the ratio of technology versus the S&P 500, we're now at, the highest level on record in the history of the stock market, in the history of the ratio, right? 2 other times we got to these levels. Once was in February of 2000, right before the tech bubble burst. And the other time was back in 1970 at the peak of that market, crescendo, right? And so, my thinking at this point was, last time we were kind of bouncing around this level, bad things were going to happen, but they didn't, right? Because what happened in place is that money floated toward these stocks because of the banking crisis. This is considered the safe haven. These tech stocks are, because of their fortress balance sheets, are considered basically the staples of the 1970s, for example. And, if we think about it in that context, maybe they could be, levitated a little bit longer, but eventually this relationship is going to revert to its mean, and we're way above two standard deviations above that mean today. And my suspicion is it's not going to hold for much longer.
So we've expressed the overextension in the tech sector, and it's obviously been led by our friends, the Fan Mag, Facebook, Amazon, Netflix, Microsoft, Apple, and Google. So they're leading the charge. But they're not contributing as much to the earnings side as they historically have, right? So this is kind of creating that whole building up of pressure, as you put it. We'll see what happens from here, right?
Yeah, Ned Davis Research published this chart, a week ago or so, and it really has some glaring considerations, right? Right now, if we look at Fan Mag, and honestly, if we swap Netflix or Nvidia for Netflix, it'd be even worse. Okay. But let's just go with the way it's stated here. Over the last 10 years, we've seen these gaps emerge where, basically the market cap in this Fan Mag complex has got up to 2 standard deviations above its mean in terms of its spread. Okay, where the spread is really, you're looking at market cap versus earnings contribution, right? And so right now, market cap of these names is about 22% of the S&P 500. It got there back in, I think 2020 last, and before that, 2018. Earnings back in 2018 and 2020 were closer to around 23% of the index. And so, that gap was closed by strong earnings growth at that time. But where we are today is earnings contribution is about 16%. And if you take a look at 2020, we had a similar situation where, the earnings actually were not keeping up with the market cap. And so you had significant underperformance by tech to close that gap the last time. And it actually overshot quite substantially. Today, we've got a similar situation where the earnings contribution isn't keeping up. And based on, the backdrop, the macroeconomic backdrop where, recession looks inevitable at some point in the latter half of this year, Apple, Microsoft, Google, Facebook, these stocks are not going to transcend that economic recession. They didn't the last time, even though they did better than the market in 2020 during the COVID pandemic crash. They still went down substantially. And so my suspicion is you're going to see significant underperformance by technology in order to fill this gap next time around.
Let's talk technicals. It's pretty fair to say that we're setting up for a bearish setup from what you're saying. Talk us through your thoughts here and obviously the impact of Friday's price move that you highlighted, the island reversal. What are the implications of that for the bigger picture?
Like I was saying at the outset, the setup is as bearish as I've seen it. We've got 4 degrees of trend setting up for a third wave decline. That is primary degree, intermediate degree, minor degree, and minute degree, okay? Unless we take out the February 2nd high, we should expect an utter collapse from here. If this island reversal pattern, which has a slightly better than 50% probability of resolving to the upside, if in fact it does break out to a new recovery high, that would not change the bearish picture longer term. It simply shifts us to a different count, our alternate count. The difference between our preferred count and our alternate count is that the preferred count considers the June 17th low to be the initial primary wave 1 low, and that the rally out into the August 16th high was primary wave 2. The decline into the October 13th low was intermediate wave 1 down of primary wave 3. And so that subdivision has subdivided at minor wave and minute wave as well, based on the preferred count. If that preferred count is invalidated by a higher recovery high that takes out the February 2nd high, all that does is shift the count to the October low being the bottom of primary wave 1 down, and that this counter trend advance, which is a very choppy, overlapping, waveform, which is corrective in its nature, should probably complete or terminate at around the 61.8% retracement of the entire decline off the January 4th, 2022 high into the October 13th, 2022 low. That would bring us into a point right around 4,300, 4,312 to be exact. That's the 618 retracement of that entire decline. And if we were to push up to that level, we think that would be an opportune place to short the market. And basically, if you were fortunate enough to continue to be long, that'd be the place to sell. It's 100 handles above our breakout level. Is it worth trading? Possibly. I think it's a pretty sure thing that if we break out above 4,200, that we're going to 4,300. So that's 100 points that a nimble trader could capitalize on. But from my perspective, I don't think that it's worth trading. I think the bigger picture trade is that we have a substantial epic decline to look forward to in a third wave collapse that should carry the S&P 500 as low as 2250 on the S&P. And once we get through to that level, that's when I consider a great opportunity to get long the market for a large degree counter trend advance, which would likely be wave B of a supercycle degree ABC corrective waveform that, will take years to complete before we finally get through it and begin to embark upon the next bull market. But in my opinion, that time is some distance into the future.
Wow, you do it to me every week. How do internals look?
Well, internals are probably the biggest part of the problem. I mean, last week we did get a big pop based on Friday's price action. The breadth number ended up something like 82% positive. But the 5-week moving average is well short of the February highs. And so I think around 25% or so, from a net advancing issues basis, leaves a negative divergence in place. And so, that continues to support the notion that, this is likely a bear market rally that's topping, not a new bull market. Also, if we take a look at momentum, just looking at the 5-week RSI oscillator, momentum's below the median line last week. I mean, despite Friday's huge day, right? We closed at 43%, I think. Based on that, we also have a negative momentum divergence in place, which between breadth and momentum, those two negative divergences give me a lot of ammunition to want to avoid getting long stocks here. And then finally, net advancing volume had a big week last week. I think 13 to 1 was the net advancing volume based on Friday's closing data, right? Well, okay, we had a huge day Friday that offset, kind of a steady decline. But actually, Friday's overall volume was only like 10 billion shares, well below the 12 billion shares that traded on average the prior 4 days. And so, for such a big day, yeah, many stocks were up versus down. There's a lot of short covering in banks and things like that. But it was less impressive than it looks on the surface. And if we look at the 5-week moving average, it's 4 to 1 up down. That's up from 3 to 1 last week, but it's well below 5, 6 to 1 that you really need to kind of give you kind of the thrust that you'd be looking for a sustained, durable advance. And I just don't see that materializing from the internals today.
So that rolls us into investor sentiment. Obviously, investor sentiment, everyone you speak to, it does feel quite tentative, and that's also what you're highlighting in a note.
Well, when Janet Yellen and Jay Powell come out every other day and somebody else from the Fed saying, it's the end of the world because there's a debt ceiling crisis. And, if we default, if we don't solve it, the U.S. is going to default on their debt. No, they're not. Okay. U.S. is not going to default on their debt. They're going to have less money than they need to pay all of their bills. That doesn't mean that they're going to skip interest payments necessarily. I mean, if it were to, sustain and they can't come to an agreement for, say, the next 6 months, then it's probably going to come to that. But that doesn't mean that at some point they're not going to resolve it. And then once they do, they're going to instantly pay all those interest payments and bring us back into flow. It's kind of a technicality sort of thing. And at the end of the day, no one in politics wants to be responsible for the consequences of that. And so I just don't think it's going to happen. Maybe we get an 11th hour decision. Maybe we overshoot by an hour or two, but eventually it's going to be resolved. It's not going to be the end of the world that they say. And that's why, John Q. Public, the average individual investor, is so bearish. We saw AAII bears, the bull bear spread widen out to almost 21%, but that wasn't because the bulls declined. It was because the number of bears increased dramatically from neutral. And so I don't necessarily disagree with that position. I think there's a lot of other reasons to be bearish, but the TV headlines aren't really the main reason. The other thing is, if you take a look at the name exposure index, this is the National Association of Active Investment Managers, they're at 67% net long as of last week, okay? And this survey is taken on Wednesdays, okay? And we had, a major collapse in regional banks on Wednesday, right? And so if they're still 67% invested in that, my guess is following Apple's earnings and, a big rally on Friday, they're probably more invested now. And so, the pros are pretty much fully invested, 70-75%. It's kind of the midpoint of being fully invested. They can get leverage. We're not leveraged. Below 50%, you start to kind of wonder, they're underexposed. But at this point, it's pretty average exposure for them.
Let's look at some sectors before we get on to our top picks. Obviously, last week, energy got smoked versus its peers. Any
Well
others
put.
notice?
It was a tough week all around. The only sector that actually had a positive, performance was tech, and that was up 0.25%. Largely driven by Apple, right? The S&P ended up closing the week down, I think, 0.78%. So almost a percent. Despite this big recovery on Friday, which was like a 61.8% retracement to the penny. So I think it was a technical retracement. Energy was down 5.76%. Financials were down 2.5%, despite a big short covering rally on Friday. So that's where the weakness is. I think financials continue to be the sector to avoid. I think energy is a sector I'd be buying. Take a look at what Warren Buffett's buying. The only stock he's buying is Oxy Petroleum. He's not going to buy the whole company, but he could buy up to 50% of it, he said. And I think he's only at 27% now. So he likes the fundamentals in energy. And I think it's, it's a really, really undervalued sector that continues to be underowned relative to history. And it's a significant economic sector. I would not ignore energy. Maybe it's not going to be as good a performer as it was the last 2 years, but I think it's a good place to have capital allocated to right now, because it's something that's real, right? It's material. It's not, it's not 28 times, next year's cell phone sales at $1,500 a unit in a recession. Do the math on that. I don't think you're going to fare well. Maybe the price of oil comes down, but it looks like the Saudis want to keep it elevated. My guess is that the Saudis are going to continue to cut production if we go into a recession. They want to keep that price of oil elevated. Oil companies are coining money at $65 a barrel, and I don't think we'll break that level.
Well, it's all about a tangible asset, right? So we looked at sectors. Let's have a look at some top actionable trade ideas as you give us every week. What do we like?
Absolutely. As you know, last week we talked about our top ranked sectors. The number 2 ranked sector is healthcare. We find a name in healthcare that looks particularly attractive. Zoetis. This is the veterinary pharmaceutical company that was spun out of Pfizer a number of years ago, symbol ZTS. Stock trades 185 at the close last night. It broke out above 183 following the, basically to resolve a classic pattern base formation of the head and shoulders, inverted head and shoulders variety, about a year in the making. That breakout above 183, if it sustains, targets 241, about 30% upside potential. We'd set a stop loss at 173 to lock in a 3-to-1 positive risk skew on the trade. On the short side, recall materials were in kind of the weaker segment of our sector rankings. We think Mosaic, a fertilizer company, symbol MOS, went out last night around $38. The stock's quite weak. It broke down below $43. Something of a, kind of irregular triple top formation looks to have been resolved to the downside. Based on this formation, we could target a downside target of $19, so about 50% upside for a short seller. You'd lose 50% if you're long the stock, so we would avoid it if you're a long-only investor. We'd set our stop loss at $44 for shorts. That locks in a nice 3-to-1 positive risk skew as well.
Jeff, as always, appreciate you sharing your thoughts from Alpha Insights, and look forward to catching up next week.
Always a pleasure, Mehdi.
And I want to thank our viewers for watching, and make sure you check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, good luck investing.